If you want to see the future of the American banking system, you don't need a crystal ball. You just need to look at a single building in downtown St. Louis. The AT&T Tower, a massive 44-story skyscraper that once symbolized corporate dominance, was valued at $205 million not long ago. But in a transaction that shocked the entire financial world, that same building was sold for just $3.6 million. That is a 98% loss of value, wiping out nearly $250 million of equity and debt in a single stroke. In New York City, the prestigious tower at 1740 Broadway, once valued at over $600 million, was dumped for less than $200 million. The lower tranche bondholders who financed that deal got exactly 0 cents on the dollar back. They were completely vaporized. These are not isolated incidents or one-off anomalies in bad neighborhoods. They are the warning shots of a systemic collapse. We are witnessing the great devaluation, a mathematical reset of asset prices that the Federal Reserve is powerless to stop. The banking system is sitting on a mountain of these toxic loans, pretending that they are still worth the full amount. But the market has spoken, and the truth is that hundreds of billions of dollars in bank capital have already ceased to exist. Before we expose the specific banks that are holding this toxic waste and what you need to do to protect your liquid cash immediately, please make sure you are firmly subscribed to the channel so you do not miss the urgent updates on this developing financial crisis. And comment down below with the name of your state. I want to see which parts of the country are waking up to this reality first. To understand why a $200 million building sells for $3 million, you have to look at the maturity wall. This year, in 2026, over $1.5 trillion of commercial real estate debt is maturing and coming due for payment. These loans were written during the free money era of 2020 and 2021, when interest rates were effectively zero. Developers and corporations borrowed massive amounts of cash to buy buildings, assuming that the good times would last forever. They structured these deals as short-term, interest-only loans with a massive balloon payment due at the end of the term. The plan was never to pay off the loan. The plan was always to refinance it into a new loan when the old one expired. This refinancing machine is the engine that has driven the American economy and real estate market for the last 40 years. But today, that machine is broken. The gears have been stripped and the engine has seized up completely. The loans coming due right now carry an interest rate of 3% or less, which is historically incredibly low. If that developer walks into a bank today to refinance, they are hit with a new rate of 7, 8, or even 9%. This immediately doubles or triples their monthly interest payment, destroying the cash flow of the property instantly. But the interest rate shock is only half of the problem. The other half is the complete collapse of income. The work-from-home revolution that started in 2020 has calcified into a permanent structural change in the labor market. Employees are refusing to go back to the office, and corporations are realizing they don't need to pay for empty cubicles. Vacancy rates in major metropolitan areas have hit record highs, with some cities seeing 30% of their office space sitting empty. An empty building does not generate rent, and without rent, the landlord cannot pay the mortgage, no matter what the interest rate is. This creates a double helix of destruction, rising costs and falling revenue hitting the balance sheet simultaneously. When a building loses its tenants, its value drops not just by a little, but by a massive multiple of its lost income. Commercial real estate is valued based on cap rates, a formula that determines price based on the cash yield of the property. As interest rates rise, cap rates rise, which mathematically forces the value of the underlying asset to crash downward. This is why we are seeing 90% price cuts on buildings. It is just the math of the new interest rate environment playing out. But here is where the story shifts from a real estate problem to a banking crisis that affects your life savings. Who lent the money to build these empty towers and deserted shopping malls in the first place? It wasn't the giant too-big-to-fail banks like JP Morgan or Bank of America. They largely exited this market years ago. It was the regional and community banks, the ones with branches in your local grocery store and on your main street. Regional banks hold nearly 70% of all commercial real estate debt in the United States today. They loaded up on these loans because they offered slightly higher yields than treasury bonds during the low-rate years. Now, these loans are turning into zombie assets that are eating the bank's capital reserves alive from the inside out. The bank cannot foreclose on the property because if they do, they have to realize the loss immediately. If a bank lends $100 million on a building that is now worth $20 million, they have an $80 million hole. For a small regional bank, an $80 million loss could wipe out their entire equity buffer and make them insolvent. So they are trapped in a nightmare scenario where they cannot sell the loan, they cannot foreclose, and they cannot get paid. They are resorting to a strategy that Wall Street insiders call extend and pretend to keep the game going. They allow the borrower to skip payments or extend the loan maturity for another year, pretending everything is fine. They simply refuse to mark the asset to its true market value, keeping it on the books at the old inflated price. This creates a ghost banking system where the financial statements you read are completely detached from reality. You might look at your bank's annual report and see a healthy institution with strong assets and minimal losses. But if they were forced to sell those real estate loans today, they would be bankrupt before the market closed. This is exactly what happened to Silicon Valley Bank in 2023, but this time the scale is significantly larger. The maturity wall of $1.5 trillion is simply too big to hide under the rug with accounting tricks. The borrowers are starting to walk away, mailing the keys back to the bank in what is called jingle mail. Major asset managers like Brookfield and Blackstone have already defaulted on huge office towers in Los Angeles and New York. They have done the math and realized that it makes more business sense to default than to keep paying a losing mortgage. When the biggest, most sophisticated investors in the world are walking away from their debts, you know the system is broken. This leaves the banks holding the bag, stuck with millions of square feet of empty office space they don't know how to manage. This brings us to the credit crunch that is currently strangling small businesses and the real economy. Because banks are hoarding cash to prepare for these inevitable losses, they have stopped lending to everyone else. The Loan Officer Survey from the Federal Reserve shows that lending standards are tighter now than during the 2008 crash. If you are a small business owner trying to get a line of credit to buy inventory or make payroll, you know this pain. The bank will not lend to you because they are terrified of their own balance sheet and their exposure to real estate. This sucks the liquidity out of the economy, causing a slowdown that leads to layoffs and a recession on Main Street. It is a silent crash because there are no dramatic lines of people waiting outside the bank, like in the Great Depression. Everything happens digitally. Your loan application is just denied by an algorithm, and your credit limit is quietly slashed. The regulators in Washington, including the FDIC and the Federal Reserve, are fully aware of this disaster. They are quietly encouraging banks to merge, hoping that bigger banks can absorb the toxic waste of the smaller ones. But merging two insolvent banks does not create one healthy bank. It just creates a larger, more dangerous insolvent bank. We are seeing a slow-motion consolidation of the banking system, where thousands of local banks will disappear. The problem bank list, maintained by the FDIC, is growing rapidly, although the specific names are kept secret. They don't want to panic the public, so they hide the data, leaving you to guess if your bank is safe. But you don't have to guess if you look at the bank's exposure to commercial real estate relative to its total capital. Some banks have 3 or 4 times their total equity invested in these risky commercial loans. If that portfolio drops by just 20%, the bank is technically wiped out and has zero value left. And as we saw in St. Louis and New York, prices are not dropping by 20%, they are dropping by 90%. The math simply does not work, and no amount of government spin or regulatory forbearance can fix it. We are heading toward a resolution weekend, where the FDIC will have to step in and seize dozens of banks at once. They will try to do it quietly, usually on a Friday evening after the markets close, to minimize the panic. But in the age of social media and instant information, you cannot hide a banking collapse for very long. The depositors will find out, and the digital bank run that follows will drain the liquidity in seconds. This is why the bail-in laws we discussed in previous videos are so critical to understand right now. The government has explicitly stated that they do not want to use taxpayer money for future bailouts. Instead, they will look to the bank's own liabilities, which means your deposits, to recapitalize the failed institution. If you have more than the FDIC insurance limit in a single account, your money is legally at risk of confiscation. It can be converted into bank equity, effectively turning your cash savings into worthless stock in a failed bank. This is not a conspiracy theory. It is the law of the land under the Dodd-Frank Act and international banking accords. The maturity wall is the trigger that could activate these bail-in protocols for the first time in U.S. history. As the defaults mount this year, the insurance fund that protects deposits is going to be drained rapidly. The FDIC does not have enough money in its own coffers to cover a systemic collapse of the commercial real estate sector. They have a credit line with the Treasury, but ultimately, the hole is bigger than the safety net. This reality is forcing smart investors to rethink where they keep their liquid cash and operating funds. The old strategy of leaving millions of dollars in a single business checking account is now financially suicidal. You are effectively lending your money to a distressed hedge fund that is speculating on empty office buildings. The return you get on that risk is zero, but the potential loss is total and complete devastation. We are seeing a massive migration of capital away from regional banks and into treasury bills and money market funds. Investors are realizing that they would rather lend directly to the government than to a risky regional bank. This capital flight exacerbates the problem for the banks, draining their deposits just when they need them most. It accelerates the collapse, creating a self-fulfilling prophecy of failure that feeds on itself. The maturity wall is not just a real estate problem, it is a solvency test for the entire fiat banking model. It exposes the inherent fragility of a system built on fractional reserves and mismatched duration of assets. Banks borrow short your deposits and lend long real estate loans, hoping that nothing breaks in between. But now everything is breaking at once, and the timeline for a resolution is shrinking by the day. The sheer volume of debt maturing in 2026 ensures that this story will dominate the financial news all year. Every month, another massive tranche of loans expires, and another wave of difficult conversations happens. Every month, more keys are mailed back, more foreclosures are filed, and more losses are crystallized. The slow bleed is turning into a hemorrhage, and the patient is running out of blood. The financial hemorrhage is not confined to the sterile glass office towers of Manhattan or San Francisco, despite what the media focuses on. It is spreading rapidly into the one sector of the real estate market that was supposed to be the safe haven for investors. I'm talking about the multifamily sector, the apartment complexes and residential buildings that house millions of American families across the country. During the speculative frenzy of 2021, a new class of investor entered this market, known in the industry as the real estate syndicator. These were aggressive investment groups that pooled money from doctors, lawyers, and retirees to buy massive apartment blocks at record prices. They bought these properties, assuming that they could raise rents by 20% every single year forever, without any pushback. But the most dangerous part of their strategy was the debt they used to finance these massive acquisitions. They did not use 30-year fixed mortgages. They used aggressive floating rate bridge debt to maximize their leverage and returns. These loans have interest rates that adjust every 30 days based on the Federal Reserve's benchmark rate. When they bought these buildings, their interest rate was 3%, and the numbers looked fantastic on a spreadsheet. Today, those same loans are charging 8 or 9% interest, and the monthly payment has tripled overnight. This has completely destroyed the cash flow of thousands of apartment complexes across the Sun Belt and the Midwest. The rental income from the tenants is no longer enough to cover the mortgage payment to the bank. This is called negative leverage, and it is the financial equivalent of bleeding to death slowly. But the syndicators cannot sell the buildings because the market value has dropped below the loan amount. They are trapped in a burning building with no exit, and they are taking their investors down with them. We are seeing a wave of cash calls, where syndicators beg their investors for more money just to keep the lights on. But the investors are tapped out. They have already lost their initial capital and refuse to throw good money after bad. This is leading to a massive wave of foreclosures in the residential sector, which will destabilize the broader housing market. When a 1,000-unit apartment complex goes into foreclosure, it depresses the value of every other property in the neighborhood. It creates a comparable sales problem where appraisers are forced to lower the value of all surrounding assets. This triggers a chain reaction that hits the regional banks from a completely different angle than the office crisis. Banks thought their multifamily loan portfolios were safe because everyone needs a place to live regardless of the economy. They forgot that everyone needs a place to live does not mean everyone can pay rent that covers an 8% mortgage. The math is broken, and the banks are now facing a two-front war against both office and residential defaults. But there's a third front opening up in this war that is perhaps the most terrifying of all for citizens. It is the collapse of the municipal tax base in the major cities where these empty buildings are located. Commercial real estate taxes are the primary source of revenue for massive cities like New York, Chicago, and Boston. When the value of an office tower drops by 50%, the property taxes collected by the city drop by 50%. This creates a massive budget hole for the city government, forcing them to make impossible choices immediately. They have to cut essential services like police, sanitation, and public transit to balance the budget. But cutting services makes the city dirtier, less safe, and harder to live in for the residents. This drives more people and businesses to leave the city, which lowers the property values even further. This is the urban doom loop, a self-reinforcing spiral of decay that destroys the economic viability of a city. And who holds the municipal bonds that fund these cities? The exact same regional banks that hold the real estate loans. So the banks are getting hit on their loans, and they are getting hit on their bond portfolios simultaneously. It is a systemic fragility that has not been seen since the Great Depression of the 1930s. And just like in the 1930s, the shadow banking system is exacerbating the crisis in ways regulators cannot see. As traditional banks pulled back from lending in 2024 and 2025, unregulated private credit funds stepped in to fill the void. These are massive pools of capital managed by private equity firms that are not subject to bank regulations. They lent hundreds of billions of dollars to risky companies and real estate projects that banks rejected. Now, these private credit loans are starting to default at an alarming rate as the economy slows down. But unlike banks, private credit funds do not have to mark their assets to market value every quarter. They can pretend that a bad loan is still worth 100 cents on the dollar for a long time. This volatility laundering creates a false sense of stability in the market that masks the true rot beneath the surface. But eventually, the investors in these funds want their money back, and that is when the truth comes out. We are seeing redemption gates being erected by major real estate funds to stop investors from withdrawing cash. When you tell an investor they cannot have their money, panic sets in instantly and spreads like a virus. It destroys trust in the entire financial system, leading to a liquidity crisis where everyone wants cash at once. And cash is the one thing that the banking system does not have enough of right now. The liquidity coverage ratio, a key metric of bank health, is flashing red for dozens of institutions. They have plenty of assets on paper, but those assets are illiquid loans and depreciating bonds. They cannot sell a 30-story office tower in 24 hours to pay a depositor who wants their cash. This duration mismatch is the classic cause of every bank run in human history. The bank borrows short, your deposits, and lends long, real estate, hoping you don't ask for your money back. But in the digital age, a bank run does not happen in line on the sidewalk. It happens on Twitter. It happens in a WhatsApp group where venture capitalists tell their portfolio companies to pull funds immediately. We saw this happen with Silicon Valley Bank, where $42 billion left the bank in a single afternoon. Today, with the FedNow instant payment system, a bank run can happen in seconds, not hours. A bank can be solvent at 9 a.m. and completely drained of liquidity by 9:15 a.m. on a Tuesday. This speed of failure renders the regulators completely useless. They cannot react fast enough to save the institution. By the time the FDIC announces a takeover, the money is already gone and the damage is done. This is why the unrealized losses on bank balance sheets are so critical to understand right now. During the pandemic, banks took in trillions of dollars in new deposits from stimulus checks. They used that money to buy safe U.S. Treasury bonds and mortgage-backed securities yielding 1%. But as the Fed raised rates to fight inflation, the value of those low-yield bonds crashed significantly. If you own a bond paying 1% and a new bond pays 5%, your bond is worth less. The banking system is sitting on over $600 billion of these unrealized losses today. As long as they don't have to sell the bonds, they can ignore the loss and pretend they are solvent. But if depositors demand their cash, the bank is forced to sell these bonds at a huge loss. This crystallizes the loss, wipes out their capital, and drives them into instant bankruptcy. It is a trap that the Federal Reserve set for the banks, and now they are caught in it. The Fed creates the inflation, then raises rates to fight it, destroying the banks in the process. And the Bank Term Funding Program, BTFP, which was the emergency lifeline, has expired. The banks are now flying without a net, exposed to the full force of the market volatility. This is why we are seeing a scramble for re-hypothecation in the plumbing of the financial system. Banks are trying to pledge the same collateral multiple times to secure enough liquidity to survive the day. It is a dangerous game of musical chairs, and the music is about to stop abruptly. The reverse repo facility at the Fed, which acted as a massive buffer of cash, is nearly empty. This drains the excess liquidity from the system, leaving the banks with no cushion against a shock. And the shock is coming from the commercial real estate sector, which we discussed in Part 1. The maturity wall is the catalyst that forces the banks to realize their losses and admit insolvency. But there's another layer to this crisis that affects the average American directly. It is the impact on the FDIC insurance fund, which is supposed to protect your deposits. Most people believe that the government guarantees their money up to $250,000, but the FDIC only has about 1% of the total insured deposits in actual cash reserves. If a massive wave of failures hits, that fund will be depleted in a matter of weeks. They will have to ask Congress for a bailout, which means printing trillions of dollars more. This debases the currency even further, creating an inflation loop that destroys your purchasing power. So even if you get your dollars back, they will buy significantly less at the grocery store. This is the insidious nature of a banking crisis. You pay for it one way or another. You pay for it through a bail-in confiscation, or you pay for it through inflation theft. There is no free lunch, and the bill for the last decade of excess is finally due. The credit default swaps, CDS, on major U.S. banks are starting to tick higher, signaling fear. And that is where the true systemic risk lies, hidden in the fine print of contracts. The true systemic risk to the global economy is not the office tower in downtown Chicago standing empty today. It is the quadrillion-dollar web of bets and insurance contracts tied to the value of that empty tower. I'm talking about the derivatives market, a complex financial casino that dwarfs the real economy by orders of magnitude. When a regional bank lends money for a commercial real estate project, they rarely keep the entire risk. They often sell credit default swaps or bundle the loans into commercial mortgage-backed securities to sell to global investors. This spreads the risk of a single default across the entire global financial system like a deadly contagion. A pension fund in Europe might own the risk of a shopping mall in Ohio without even knowing it. An insurance company in Japan might be holding the bag for an apartment complex in Texas, assuming it is safe. This interconnectedness was supposed to make the system safer by diluting the concentration of risk among many players. But when the entire asset class of commercial real estate collapses at once, diversification does not help you at all. It simply means that everyone goes broke at the same exact time, leading to a synchronized global crash. And the trigger for this crash is the counterparty risk embedded in every single derivative contract in existence today. A derivative is just a contract between two parties. If one party goes broke, the contract is completely worthless. If a regional bank sold insurance on a loan and then goes insolvent, the insurance is void and pays nothing. This creates a domino effect, where the failure of a small bank can topple a massive hedge fund overnight. We saw this exact scenario play out in 2008 with AIG, and we are seeing the warning signs again today. The notional value of derivatives held by US banks is significantly higher than the total GDP of the entire world. Even a 1% loss in this massive market is enough to wipe out the equity of the banking system. And the maturity wall of 2026 is the sharp pin that is pricking this massive leverage-filled bubble right now. As defaults rise, the cost of insuring against default rises, putting massive financial pressure on the entire banking chain. This brings us back to the most critical question for you as an individual depositor and concerned investor today. If the banks are insolvent, the real estate is crashing, and the insurance fund is empty, what do? How do you protect your life savings from a system that is seemingly designed to confiscate them to save itself? The first step is to acknowledge that return of capital is now infinitely more important than return on capital. You should not be chasing a 5% yield if it puts your 100% principal at risk of loss. You need to move your money out of the blast zone of the regional banking system immediately and without hesitation. This means diversifying your liquid cash across multiple institutions to stay strictly within the FDIC insurance limits. If you have $500,000 in one bank, you're taking a risk you simply don't need to take. Split it into two accounts at two different banks to ensure every single penny is covered by the federal insurance. But for larger amounts, or for those who don't trust the insurance fund's solvency, you need to exit the system. This does not mean stuffing cash under your mattress, which carries its own significant risks of theft and fire. It means becoming your own central bank by holding bearer assets that have absolutely no counterparty liability attached to them. U.S. Treasury bills are the most direct way to lend money to the government without a bank in the middle. You can buy T-bills that mature in 4 weeks or 3 months, paying a yield that is effectively risk-free. In a banking crisis, Treasury bills are considered pristine collateral and are often more liquid than actual cash deposits. The second tier of protection is physical precious metals, specifically gold and silver coins and bars held in your possession. Gold is the only financial asset that is not someone else's liability on a balance sheet. It stands alone. It has survived every banking collapse, hyperinflation, and war in human history for 5,000 years without going to zero. Central banks around the world are buying gold at record rates right now for this exact strategic reason. They are de-risking from the dollar and the U.S. banking system to protect their national wealth from sanctions and instability. China, Russia, and even European central banks are actively repatriating their gold reserves to their home soil for safekeeping. They know that if the U.S. banking system freezes or fails, they want their physical wealth in their own vaults. You should follow the smart money and do exactly what the central bankers are doing right now with their own reserves. Allocate a portion of your portfolio to physical assets that cannot be erased by a computer glitch or a bank holiday. Silver offers a unique opportunity because it is both a monetary metal and an industrial necessity for the future economy. The industrial shortage of silver is colliding with monetary demand, creating a potential super spike in value in the coming years. This creates a hedge that could offset losses in other parts of your portfolio during a collapse of paper assets. But beyond gold and silver, you need to look at your personal debt exposure in this crisis immediately. If you have a variable rate mortgage or high interest credit card debt, pay it off immediately to reduce your monthly burn rate. As banks tighten lending, they will raise rates on existing credit lines and cut credit limits aggressively to reduce risk. You do not want to be at the mercy of a desperate bank that needs to squeeze you for cash flow. Eliminating debt gives you the staying power to ride out the economic storm without being forced to sell your assets. The next few years are going to be a period of massive wealth transfer from the indebted to the liquid. Those who have cash and no debt will be able to buy distressed assets for pennies on the dollar. Imagine being able to buy that $300 million office tower for $28 million cash when the dust settles. That is the opportunity that awaits the patient investor who survives the initial crash intact and ready to deploy capital. But to survive, you must be vigilant and ignore the comforting lies coming from the mainstream media every single day. They will tell you that the banking system is sound and resilient, right up until the moment it completely fails. They told us Silicon Valley Bank was fine on Thursday, and it was seized by the government on Friday morning. They told us inflation was transitory for 2 years, while your cost of living skyrocketed permanently and destroyed your budget. They are not paid to tell you the truth. They are paid to maintain confidence in the crumbling financial system. Your job is to look at the raw data, the maturity wall, the vacancies, the bond losses, and decide for yourself. The data says that the math does not work, and a correction is mathematically inevitable regardless of what politicians say. We are watching a slow-motion train wreck, but you have time to get off the tracks if you act now. The bail-in laws are real, the real estate losses are real, and the bank insolvency is real and documented. Do not be the greater fool who leaves their life savings in a vulnerable institution out of habit or laziness. Take control of your financial destiny by becoming your own bank and diversifying your counterparty risk before it is too late. This crisis will reshape the American economy, wiping out the middle class and consolidating power at the top of the pyramid. The big banks will get bigger, the small banks will disappear, and the average citizen will pay the price for it. Unless you position yourself on the right side of the trade before the panic starts and the doors close. The window of opportunity to move capital freely is still open, but it may not stay open forever for everyone. Capital controls, withdrawal limits, and bank holidays are tools that governments use in desperate times to stop the bleeding. We saw it in Cyprus, we saw it in Greece, and we could see it here if the panic spreads. Get your financial house in order today, this week, not next month or next year when the panic hits. Review your bank accounts, check your insurance limits, and consider buying physical assets to protect your family's future wealth. Talk to a financial advisor who understands the risks of the current banking environment and can help you navigate it. Do not let inertia be the reason you lose everything you have worked for your entire life to build. The system is blinking red, the alarms are sounding, and the exit doors are slowly closing on the middle class. The $1.5 trillion debt bomb is exploding right now, whether you acknowledge it or not in your life. The only question is whether you will be a victim of the explosion or a survivor of the aftermath. The choice is yours to make, but the time to make that choice is running out rapidly this year. We will continue to monitor the problem bank list and the specific institutions at risk to keep you informed daily. We will track the commercial real estate foreclosures and the impact on municipal budgets in your city and state. And we will bring you the truth about the economy, no matter how uncomfortable it is to hear right now. Because in a world of financial deception, the truth is the only asset that matters for your survival. Thank you for watching this breakdown of the banking crisis of 2026 and the coming collapse. If you found this information valuable, please hit the subscribe button and the notification bell to stay updated. Share this video with anyone you know who has significant deposits in a regional bank to warn them now. You might just save their financial future and protect them from the disaster that is coming for the uninformed.